Right on the dot. My clock says 12 noon and my phone. How about yours? Thanks for joining me today. I'm very pleased with the interest in this account. It confirms to me that I didn't waste those countless days and nights going over the statute as many times as I can to make sure that I have the right answers for you. So today, we're here to talk about Trump accounts, what every advisor needs to know. My name is Denise Appleby. They call me the IRA Whisperer because I do things like this. It's fun for me. They send out new tax laws. I pull out different sections. I pull out the statute and I go over it again and again and again to make sure I have the answers. And to that end, for today's presentation, send me all the questions that you have. I promise you, if I can't respond live, I'll make sure I follow up with a response. So what are the learning objectives for today? We're going to be looking at who's eligible for a Trump account. And here's why this is important. And one of the reasons why I don't look at proposed regulations. I wait until it's final because there are a lot of differing opinions on who's eligible. But to get the answer, you want to look at the bill that was signed into law, right? So we're going to talk about who's eligible. We're going to be talking about the $1,000 pilot program, which is one of the hottest topics that came out of this thing. And one of the questions that I get a lot is, Denise, why should I do a Trump account? Why not do a 529 plan instead? I'll answer that question as well. I'm going to be looking at how are the distributions taxed? Because we know when we add money to any one of these accounts, eventually those monies comes out as distributions. And of course, the important question is how much of it is going to be taxed and how does income tax apply? So let's answer the question once and for all. What is a Trump account? The Trump account was created on the OBBBA. Say it fast, right? The one big, beautiful act that was signed into law on July 4th, 2025. So I know everyone in the audience right now knows what a traditional IRA is. The Trump account borrows much of its rules from the traditional IRA. For instance, contributions are tax deferred. Earnings are taxable when distributed, but there are some differences. The Trump account has its own set of rules up until the year the child reaches age 18. For instance, you can't take any distributions from the account before that year. So even though the starting language usually is, oh, it's like a traditional IRA, we have to look at what the differences are because not all of the traditional IRA rules apply to these Trump accounts. Here's something that jumped out at me as I was going over the statute. No contributions will be accepted before the date that is 12 months after the date of the enactment of this section. And what that says to me is, yeah, we can learn all we want about Trump accounts now, but the bottom line is no contributions will be accepted to those accounts before July 4th, 2026. So we have a ways to go, right? But what we have to remember is that this is new. Platforms will have to change, forms will have to change or created to accept these contributions. So this gives the Trump account custodian or trustee time to get ready to accept those contributions so they can know how to report them. And they can know how to report distributions as well when they do occur. So one of my clients says to me, then Denise, why do you have me here talking about this if it's not ready until a year from now? Well, clients are going to be asking you about Trump accounts, right? And you don't want to be the advisor who's going to say, well, I don't know because it's not ready yet. You want to be able to say, yeah, I know what that is. It's not ready yet, but here are the rules as we have them now. Here's what determines if you can make a contribution for your child to a Trump account. And one of the things I like about this account is that it starts a retirement nest egg for a child. Most retirement savings account require the child to have income. That's not the case with a Trump account. So you can start funding the Trump account for your child so that they can start saving for retirement. That's one of the best things I like about this account. So if you're the advisor who knows all of this, then you have that competitive edge. Here's why this matters later. When you look at the stats, when you ask adults, do you have anything saved in a 401k, 403b, or IRA? 40% of adults said no. And we don't want our children to be in that position, right? And one of the ways that we can do this for children who don't have eligible compensation like wages or salary or self-employment income is to start funding a Trump account when they become eligible. So who is eligible? Any child who's under age 18 as of the year that the election is made. They must have a social security number. And the election for a Trump account can actually be made by the IRS or by another person in the manner as prescribed by the IRS. And my reading of this is the IRS can just say, oh, we're going to be making a pilot contribution to your Trump account. As to how the mechanics of that will work, we don't know yet. My suspicion is that it's going to work sort of like what you do when you get your tax refund and you put on the tax return that, hey, send my tax refund to my IRA. It's going to be something like that, which means that the Form 1040 will have to be updated so that parents can indicate that they have a qualifying child. No compensation requirement. Beautiful thing. Right now, when we have conversations about funding an IRA for a child, one of the fundamental requirements is that the child must have eligible compensation. There's no compensation requirement for a Trump account, which means that whether or not your child is working, they can fund these accounts up to eligible amounts. So let's talk about distributions and contribution rules. The first one I want to talk about is the pilot program and who's eligible. I have a grandson, his name's Noah. He's not eligible for this because he was born before 2025. So he's not eligible for the pilot program. The child has to be born 2025 to 2028 to be eligible for the pilot program. They must be a US citizen. No prior election can be made for that child. So when the parent makes that election on the tax return, I'm assuming that's how it's going to be done. The question becomes, have you made that election before? Because if you did, you can't do it a second time. This is a one-time contribution. Okay? The child must have a social security number, and the election is going to be made on the tax return or in any other manner that the IRS provides. So we talked about the pilot contribution, which is a one-time contribution, but there are annual contributions that can be made by a parent, guardian, or other individuals. And that's up to $5,000 per year. Then employers, if they participate in the program, they can make up to $2,500 per year per qualifying child. So the employer can say to their employees, oh, we have this program, just like they would explain, say, a SEP IRA program or a profit sharing contribution. We have this program under which we are going to fund a Trump account for your qualifying child up to $2,500, and we're going to do this each year. Now, there's another category of contribution that can be made by government or charities. And there's a special calculation that has to be done to determine how much each child gets. And it has to be done on a non-discrimination basis to an approved group of children. So we have the $5,000, the $2,500, we have the pilot contribution, and then we have the general funding contribution, right? So we know how the money can get in the account. At least we know how much can be contributed each year. As to the how and the who, we're waiting on the IRS for that, right? Now, the distribution rules. This is one of the rules that separates the Trump account from a regular traditional IRA. You cannot touch those funds before the child reaches age 18. This is not like an IRA where you can say, you know what, I'm a little hard up for funds, or my child needs some money. Let's take a distribution and we'll deal with the tax consequences. That's not an option for Trump accounts. The money has to sit there until the year the child reaches age 18. Now, in the calendar year that the child reaches age 18, and by the way, when I say reaches age 18, I mean in the calendar year. So whether it's January 1st or December 31st, it doesn't matter. So in the calendar year that the beneficiary reaches age 18, beneficiary and child is interchangeable in this instance, the, the Trump account is treated like a traditional IRA. One of the questions that I get is, well, Denise, is this automatic? We don't know yet. So we have to wait on the IRS for guidance on that. I know that some financial institutions, when they set up traditional IRAs for minor, it might be labeled as a minor account. And once a child reaches the age of majority of the state, then they can flip that account to an adult account. I don't know if that's how this is going to work. And I don't think that's how it's going to work. And I'll talk about why later on, particularly because of the tax reporting requirement for distributions. Now, distributions are generally taxable as ordinary income. Keyword here is generally, because guess what? The pro rata rules apply. You know how if you have a traditional IRA and you have basis in the account, then distributions of the basis is non-taxable, right? Basis would come from a non-deductible traditional IRA contribution. However, distributions, with a few exceptions, include a prorated amount of pre-tax and after-tax assets. So let's look at an example. We're assuming that this child receives a pilot contribution, then they get parent contributions annually for 17 years, assuming a reasonable growth rate of 5%. At age 18, the fair market value is going to be about $131,000. If a child says, I want to take a distribution of $100,000, then it's going to be prorated. 35% of that is going to be earnings. 64% is going to be basis. So using those numbers, the non-taxable portion is going to be about $64,000. The taxable portion is going to be about $35,000. And the 10% early distribution penalty applies because remember, this account borrows many of the rules from traditional IRAs unless the statute says otherwise. And the statute did not include any exception to the 10% early distribution penalty. So if the child does not qualify for any of the exceptions that apply to a traditional IRA, they will owe the 10% early distribution penalty. I see your questions. I'm not ignoring you. I'll get to them. So in this case, $64,642 will be non-taxable. Taxable amount will be $35,358. And the question becomes, what's the purpose of the funds? What is the funds being used for? Because unless it's being used, say, for higher education expenses or any of the other exceptions that apply to a traditional IRA, then the 10% early distribution penalty is going to apply. Here's something else too, because As of the year the child reaches age 18, the traditional IRA rule applies. It is possible that these accounts are going to be aggregated with traditional IRAs to determine with any traditional IRA that child owns to determine how much is taxable. Because remember, when we're looking at basis, all of an individual's traditional SEPs and simple IRAs are aggregated and treated as one. So will the Trump account stand on its own to determine basis, or will it need to be aggregated with any other traditional SEP or simple IRA that the child owns? We don't know. And you know me, I don't like to guess, right? But everything in the statute is pointing to these accounts being aggregated with traditional IRA. So there's some planning opportunity there for the advisor and their client. Now, if the child dies, that's an exception to the distribution before age 18. If the child dies on the date of death, the account ceases to be a Trump savings account. And the fair market value as of that date, minus any basis or investment in the contract, is treated as if it was distributed on that date. So if the recipient is not the estate, so the child has a beneficiary, then the fair market value is going to be included in the beneficiary's gross income. If they don't have a beneficiary and their estate inherit that amount, the value is includable on the child's final tax return. So here's a little spoke in the reel. There are a lot of tax reporting requirements for custodians. And so right now, I imagine custodians are having the conversation of, well, who's going to bail this cat? Because I'll tell you a little secret. Education savings account, we know that they've been capped at $2,000 since forever. And people usually don't pay education savings account any mind. So the balances are low. And rumor is at least one huge custodian that used to offer these accounts are saying, like, I don't want to get involved in this. The balance is not worth it. Right? So the question becomes, will these accounts go the way of education savings account? Because if there's not much money to be made from it, if the balances remain small, maybe custodians don't want to participate. But here's my opinion. Because one of the outstanding question is which custodians are going to offer these accounts. My recommendation is whichever custodian is already offering 529 plans and education savings account, it's easier for them. Why? Because of the basis reporting requirement. When you make a non-deductible contribution to a traditional IRA, if it's non-deductible, the IRA custodian doesn't care. They don't know. So they report any distribution from the traditional IRA as fully taxable, and then it's up to the taxpayer to claim the non-taxable portion on their tax return by filing Form 8606. But 529 plans and ESA plans are different. The custodian or trustee is required to identify the basis amount, which makes it easier for the beneficiary. Because when they take a distribution, they just look at the form and say, oh, I took a distribution of $5,000. This amount is earnings, this amount is basis, this amount is taxable, and that amount is non-taxable. So that's what the statute requires. And since custodians are already doing this for 529 and education savings account, it seems fitting that those custodians that offer those accounts would be the ideal platform for these accounts. But just my opinion, I'm not a custodian. If I was advising them, that's what I would say. So reporting contributions, the custodian or trustee must identify the amount and source of contributions over $25 made by someone other than the IRS, the account beneficiary, or their parent or legal guardian. Now, if they have to identify these contributions separately, The question becomes, do they have to say who made the contribution? That's unclear to me. It just says by someone other than these individuals. And if they have to identify the individual, the question becomes, what if 10 people make contributions to the account over $25? Are we looking at 10 Form 5498 TSA? That's what I'm calling it, Form 5498 TSA, to report the contributions. I don't know if that's going to be the number yet, but the one for education savings account is Form 5498 ESA. So unless they're going to amend that to include this as well, then we will need a new form. You can make a rollover from one Trump savings account to another. Here is another reporting requirement. The receiving trustee has to report within 30 days of that rollover contribution to the IRS. And the report has to include the name and address and social security number of the beneficiary. They have to say that they're the trustee. It has to include the account number, has to include the routing number of the trustee. So, technically nothing different from a regular Form 5498. But I'm saying, why within 30 days of a rollover? Why not wait until the usual deadline for regular Form 5498s? Hopefully, this is something the IRS will change because we know they can make changes. Now, when a qualified rollover contribution occurs, like from one traditional from Trump account to another, the entire account balance must be moved. And this must be done as a direct trustee to trustee transfer. So you can't say, oh, I have 20,000 at firm A, I want to move 10,000 to firm B. No, you got to move the entire balance. Distributions has to be reported, the fair market value of the account, the investment in the contract. That's what I was alluding to earlier. So when the custodian reports a distribution, they have to say how much is the investment in the contract or basis. And so the question becomes, where does basis come from, right? Now, there are different types of contributions as we reviewed earlier. Contribution made by the employer does not create basis. Contribution made by the IRS does not create basis. Contributions made by government and charitable organization does not create basis. Basis only comes from the contribution that is made by the parent. Why? Because they cannot take a tax deduction for that contribution. Again, here we are treating it as a non-deductible traditional IRA contribution. Now, for the year the child reaches age 18 and after, regular traditional IRA reporting rule applies. So here are some planning considerations for advisors. And if you're not an advisor and you're listening, then some of the things you can talk to your advisor about. Here's my opinion. If you're getting the free contribution, you, the parent, for your child, I would say take the pilot contributions if you want it, because someone did tell me they don't want a pilot contribution. We're going to talk later as to why they're saying that. Take the employer contributions, take the government and charitable contributions. It's free money. Who doesn't love free money, right? So take those contributions, but bear in mind that distribution of those amounts are gonna be taxable. Now, the decision, though, comes in when we're talking about the parent contribution, because now as a parent, you're gonna have to say, here I have $5,000. If I put it in the Trump account, I'm not getting a deduction. Why shouldn't I put it in a 529 instead? Because if it's in a 529, remember that if you have excess amount in a 529 plan, you can move it to a Roth IRA up to $35,000. That's a lifetime limit where it's eventually gonna be tax-free, right? So if I have $5,000 and I'm trying to decide between a Trump account and a 529 plan, I'm choosing a 529 plan because the tax results are better, right? If the child is working, then and they don't make too much money, if they're not a model and they make over the Roth IRA modified adjusted gross income limit, then put it in a Roth IRA. All of it's going to be tax-free eventually when the child is eligible for a qualified distribution. After 5 years, they can take out up to $10,000 for a first-time home purchase, and the earnings won't be taxable. Whereas in the Trump account, because it's treated like a traditional IRA, that won't be the case. And you know what? If you can afford to do all of it, then do it. But if you have to make a choice, you're going to have to compare the features and benefit of these accounts and highlight the differences in suitability for your client. So here is a comparison that I did. We're looking at someone born in 2026. They contribute $5,000 per year for 17 years. And again, we're keeping it conservative, 5%. And we're going to assume that no more contributions are added. We're also, for the purpose of mathematics, we're going to assume that we're taking everything out at age 59 and a half. What happens then? With the Trump savings account, the $85,000 contribution, and we're assuming that it's only parent contribution, is going to be basis. That's going to be non-taxable, but almost $1 million is going to be taxable. With a Roth IRA, everything's going to be tax-free. And with the 529, where you move $35,000 to the Roth IRA, you can see $718,000 is the basis and would be tax-free, whereas about $290,000 is going to be taxable. So you tell me which one would be the best option in this choice. We know that for a Roth IRA, that is off the table if they don't have eligible compensation. But, if they do have eligible compensation, then Roth IRA is a clear winner. Otherwise, the 529 plan seems like the better option to me. The numbers speak to that as well. This is the same chart, just looking at different numbers. I thought, why not add a second chart, because these are the colors of my logo, and I like pretty stuff. So same information here. So a quick recap, because I promised you that you get half an hour to go back to your lunch. But if you want to stay with me and ask me questions, I'll be here for the full hour. Highlight: eligibility is broad. As long as the child is not age 18 in the year, contributions can be made. But the rules vary by who's making the contribution, right? If it's the IRS, then you have that one-time contribution of $1,000, the pilot contribution. If it's a parent, they can do $5,000 per year, which is non-deductible. We have employers that can contribute $2,500, and we have other organizations that can make contributions. Now, the parent, it's easy to rely on the custodian to keep track of what's basis and what's not. But we know, right? And if you read my articles in Morningstar, you know that mistakes are often made. So it's possible that what the custodians say is basis is not. So it's the responsibility of the parent or beneficiary, if they're doing it, or their tax professional, to keep track of the contributions and where they come from. So if the 1099 Q or whatever 1099 is used to report these distribution is incorrect, they can say to the custodian, fix it. And if they won't, they can say to the IRS, despite what's being reported on this 1099 form, it's incorrect. Here's why, and here's the proof. Remember, there's a new planning opportunity in the year the child reaches age 18, because now we're talking about traditional IRAs. And where do you go from here? One person asked me, could the child convert it to a Roth IRA then? I'd say yes, because remember, as of that year, the traditional IRA rules kick in. Just remember that any amount that's not basis is going to be included in income. And I know it's not until July of next year that it's going to become available. But in the meantime, Custodians are building their systems, they're creating forms. We're still waiting on the IRS for guidance on how reporting is going to be done so that custodians can build or improve their system so that they can meet those tax reporting requirements. But if you're the advisor who knows that information now, as the rules change, then you have less to learn, right? Because everything else is just dribble, 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 and then you can just add it on top of what you learn. And of course, I'm always here, so you can ask me any question. I promise you, as soon as they issue guidance, I'll let you know and I'll make sure I learn it from A to Z so that I can explain it to you in plain English. Because you know what? You don't have any time for that. That's why I'm here. And now I'll take your questions. I'll send them to you, Scott. Scott's asking if the slides are available. I'll send them to attendees. This is a new program. I'm seeing a lot of misinformation out there, and I want to make sure that my people get my information, which is the right information. Do you think these will actually be IRAs at age 18 or just like IRAs? So you could do a Roth conversion, roll it into a traditional IRA, etc. Or is it going to be something different from an IRA? For the year they reach age 18, the Trump savings account rules no longer apply. But here's what we haven't figured out yet. Do we keep it in the same account and they just flip it to a traditional IRA? I don't think that's the answer. Or do we move it to a traditional IRA? Similar to what we do with 529 plans, when you move that X amount per year, not exceeding the contribution limit to a Roth IRA. I think it's going to be something like that, except that in this case, it's going to be a non-reportable transaction. There's no reason to have these reported, or maybe there is, because the issuer will have to tell the beneficiary how much of that amount is basis and how much is not, so that the beneficiary can communicate that to their tax preparer, who's going to track that on IRS Form 8606. I feel like I need to talk to the IRS, if they need help figuring out how this is done. Does one parent also need to have a social security number? The regulations, the statute does not say that. And so no, the answer is no. The requirements that are listed in the statute does not say the parent have to have a social security number. Can you file a tax return without a social security number? I know there are different types of tax identification number that you can use. For instance, you can use an ITIN. If you're filing your tax return using an ITIN and you have a child that meets the requirement, then I don't see any reason why that child would be penalized because their parent doesn't have a social security number. What are some of the limited distribution options? I've read some initial opinions. Can you make distributions prior to uh, can you make distributions prior to 18 for education or small business loan? No. See, I saw that floating around too. And again, that's the reason, people kept saying to me, Denise, what are the Trump rules? And I said, I don't know. I'm not reading those until the signature is on the bill, until it becomes law. Because usually when it moves from one place to another, there's a different version and they come together and agree. And all this stuff that you're asking about was floating around out there before the bill was signed into law. The final version does not include these exceptions. Can we get a recording of this meeting? Absolutely, Joseph. Any chance of a Roth Trump savings account? Uh, I don't know. I don't know. I haven't heard any whisper about it. I think this would have been great if it was a Roth in the first place, but I'm not in charge of that. So, I mean, why make them pay earnings on the tax on the earnings? Can a parent open a TSA for their child, or does it have to be opened by the Treasury? The parent can open it for their child. The treasurer can open it too. I'm assuming the only time the treasurer would do it is if there's not an existing account and they want to make that pilot contribution. Otherwise, it's a parent who's going to go to ABC custodian and say, "Where's your adoption agreement? Let me sign it. Let me fill out an application for the account, and you set up one for my child," just like you do with a 529 or education savings account. If my child is 15 now, what is the earliest date I can make a contribution? The earliest date you can make a contribution is July 4th of next year. Am I counting the days right? Because it says 12 months. So it's either July 4th or July 5th, depending on how you count the 12 months. Also, can you cover the differences, benefits of Trump accounts versus traditional IRA 529? Thank you. I think I covered that a little bit, but it's such a great suggestion. My part two of this will be digging deeper into what the differences are, because you really need the answer to the question of, what if my child is eligible for all of these? Which one should I choose, right? And we need to get the answer with numbers, because numbers speak loudly. So I'll do that for you, for all of us. Earlier on, there was talk of access being limited up until age 30. No, that's out the window. It sounds like in the final version, the beneficial child owner may withdraw all the funds at age 18. Is it correct? Yes, you're correct, Andrea, but why would they? This is starting their retirement funding early. So don't have them take it up. My recommendation is, unless they really need it, don't have them touch it. Have it sit there and marinate and accumulate for their retirement age, because we don't want our kids to be in the position that many of us are, having nothing saved for retirement. It seems that investment options are extremely limited. Just equity index funds with expense ratios less than 0.1%. That would only apply before age 18. Yes, because remember, for the year the child reaches age 18, they shake off the Trump banner, Trump account banner. It's a traditional IRA now, right? So regular traditional IRA rules would apply. Clarify who's eligible for the pilot. Specifically, is it means tested based on parents' income? No, there's no income limitation, no income requirement. That's one of the good things about it. Are all kids, regardless of parent income, entitled? All eligible kids, right? You gotta be born in America. You gotta be a U.S. citizen. You gotta be born from anytime in 2025 up to 2028, and you have a social security number, then you're eligible. There's no income requirement. Let me see. Thank you for offering to private slides. Of course. At age 18, the TSA is treated like UTMA or OGMA. No, at age 18, it's treated like a traditional IRA. Such great questions. If this is similar to an IRA that you must track basis, when you have an 8606 and track non-deductible contributions, I didn't see any rules against the owner rolling these into a 401k and extracting the basis and converting the earnings principal to a Roth 401k. What are your thoughts? Well, first thing is, the only thing that can be rolled to a Roth 401k is another designated Roth account. So Roth 401k, Roth 403b, Roth 457b. That's the only thing that can be rolled to a Roth 401k account. But I like how you're thinking, because come age 18, they can roll the pre-tax amount to a traditional 401k. Because remember, the basis can't be rolled to a 401k. So you roll the pre-tax amount to a traditional 401k that leaves only the basis. You convert it to a Roth, and then you avoid the pro rata rule. I like how you're thinking, Michael. See, you're already planning. I'm assuming TSAs will be included from FASFA as a retirement assets. Sounds reasonable? Yes. A lot of the rules that would apply to certain kind of savings that makes them unattractive for FAFSA, etc., and other benefits don't apply here. The whole idea is we're going to make all eligible children take these contributions, and there's nothing that's going to prevent them from doing that as long as they meet the age requirement. Thank you for answering my question and figuring out what I meant to type cover. No problem. I came in late. I'm sorry. Can the child roll this over to a Roth IRA at age 18? Yes, and it's going to be taxable on a prorated basis. So remember that basis comes from parent contribution. So at that time, Susan, you're going to have to look at the balance and say how much was contributed by parents, how much was contributed by the IRS, how much was contributed by the employer. And the form 1099, whatever version that is issued, is supposed to show how much is basis and how much is not. So that will help you to figure out how much is taxable and how much is non-taxable. Can a child that will be 13 years old as of July 4, 2026 have a Trump account that is parent funded, or must the child be born in 2025, 2028? Excellent question. So the birth 2025, 2028 only applies to the $1,000 pilot program, right? So, you know how you look at it, there's the account and there's the type of contribution. So the pilot $1,000 that is coming from the IRS, you got to be born in 2025 to 2028. Now, for a 13-year-old child, they wouldn't be eligible for that pilot contribution, but they're eligible for the parent contribution, the employer contribution, charitable contribution if there's any, right? So they're eligible for everything else. Would you be sharing slides, links? Absolutely. I totally agree that 18-year-olds should leave the funds in their TSA. IRA. I have one kid who would agree to do that, but my other kid would take the funds out yesterday. Andrea, let's show him the math, right? And tell him, you want to be working at 59 or you want to be traveling the world and sunning yourself on the beach? And have him pick and say, if you want to be sunning yourself on the beach and not be grinding like your parents and grandparents, then leave the money in there. That's the better choice. I think I answered all your questions. I want to thank you guys so much for joining me. And if there's a question that I didn't answer, please feel free to send me an email. Thanks again for joining me. I don't see any more questions. So that's it. Have a nice day, everybody. Enjoy the rest of your day. Thanks again.